Welcome to Investment 360 in the hot seat this evening. Malcolm Charles from Investec Asset Management, and I've still got in studio Wayne McCurry from Momentum Asset Management. Malcolm, thanks very much for joining us. Last night I was speaking to Anne Lapile from Investment Solutions, and we were chatting around this low yield environment as to what managers need to do out there, having to be incredibly innovative to render yield, any yield at all, to investors in the current environment. And I know that you've just done a presentation called Taking Stock. It's on the low yield environment, and you've got some thoughts on where we should be going.
Thanks very much. Yeah, it's a very tricky time for cash investors, because we're coming from a time where over the last 10 years cash gave you a real return, simply because central bankers ran positive real return monetary policy. So they set their rates above inflation, and then the banks gave you a little bit more than that. Unfortunately, those days are gone, and you're now getting negative real returns, which is a first for South Africa for a while. It's been happening internationally for the last couple of years. So I think we've got a bit of a heads up that we can see the trend that they've gone through and maybe learn a little bit from them. So we're looking at structuring portfolios where you've got to be very flexible. You've got to look for anything that gives you extra yield. And another lesson we've learned is that government paper isn't as safe as it used to be. And well, maybe go to corporates.
In terms of, well, there we go, anything that gives you extra yield, is it into the corporate bond arena?
100%. And that market's grown wonderfully over the last couple of years. It's gone from a market virtually non-existent 10, 12 years ago to 40 to 45% of bonds in issue. So there's a big pool out there. We'd like it to be a little bit bigger, because a lot of people are chasing the same paper, but there's some very good names and some good quality paper out there.
And there's appetite for it in the current environment?
There's more and more appetite. As you know, it takes a while for investors to realize that sitting in lazy cash, earning 5.25, going backwards every year because inflation is now above 6, and people suddenly realize, hang on, I'm poorer than I was in January. So what can I do? And these corporates are prepared to pay a little bit extra and beat inflation.
Money's burning hole in your pockets, effectively. That's what's happening to your cash these days.
Yeah, look, I mean, lower interest rates and very, very low, if not negative, real interest rates. Now, real interest rates is, are you earning more than inflation? Ignoring tax. By the way, in South Africa, if you're an individual paying tax at the marginal rate, you've always gone backwards.
Let's not go
that way.
Wayne,
okay.
it's my pet hate.
Okay.
Can we stay away from it? I've got to deal with it over the budget.
But lower interest rates worldwide is a phenomenon that's going to be with us for a sustained time period. So it's very difficult as a cash investor. Now, corporates, buying corporate paper or even Transnet paper, you know, you can get a 1.5%, maybe 2% more return on the paper. But of course, you know, the market's quite efficient in how it prices things. There's a reason why they have to pay more, is that although the market has developed, as Malcolm has said, enormously, there's still, let's call it restricted liquidity in these things. So you just got to be a little bit careful there. You can't always sell them at the price you want.
Into your court, restricted liquidity.
Absolutely. So diversification is key. You don't give all money to one corporate. You try and mix and match, and you go across different sectors. So your stock picking is important. But I think you've got to offset the lack of liquidity to, you know, do you want to grease on Italy, or do you want a good quality corporate that you know has got corporate governance, is audited, is clear with what they want to make money, and therefore they'll pay you back. So the money is actually safer in some of these corporates than it is in some of the old government papers.
Is that the reality in an uncertain world, that it is safer in the corporates? Wayne says yes.
Absolutely. I mean, there was a wonderful quote I read from an American investor. He says, governments used to be risk-free investments. They are now return-free investments. And
there we go.
You know, corporates are giving you what investors want. You're going to beat inflation. And if you diversify the portfolio nicely, I think you're going to have a very, very handsome return.
In theory, I mean, this is very simplistic. If corporations are paying you 2% above a similar government bond, in theory, you can have 2% of your money, you can lose the capital. That lot can go bankrupt each year, and you're in the same position. Now, in South Africa, and I also might be wrong here, I don't think we've ever had a default. I know Supergroup, the people that are a bit worried.
It came close, but it was averted.
We didn't actually have a default. So it has paid off. And certainly, I would think institutional investors in their big bond funds have probably got 30%, or maybe even 40% in corporate paper for this very reason. Now, it's lucky if you've got a big fund, you're lucky, because you're not forced to sell tomorrow. You know, money flows in, money flows out. So the restricted liquidity is not too much of an impediment in managing the money.
Is there a sectoral preference when it comes to corporate bonds?
There is, but unfortunately, in the structure of the South African market, most paper is still the bank paper. So you're forced into by default into a bank-heavy corporate market. But we would love it if more of the corporates came to the market. You know, some of them do, the SA breweries, etc., do come to the market. But the market, they need to trust the bond market a little bit more, and they need to understand that this is a good source of raising cash.
But
and as the market develops, I think that you'll have a much more balanced allocation.
One of the problems is SA corporates are cash flush. They're not expanding, so there's
they
don't really need. So they really only come in the market to roll old debt, to roll it and to build up facilities in that. But of course, I mean, as an aside comment, the bigger and bigger the corporate market gets, the less and less they're borrowing from the banks. So there's a balance between the two as to buying corporate paper and buying banking shares, because bank volumes are down because companies used to go to banks for loans. Now they go directly to the market for loans.
And that must be one of the biggest hindrances at the moment, is that corporates are so cash flush. We often discuss this on the desk.
Yeah, no, it is. As I said, we'd like to lend them money. They're saying we don't really need it.
You must tell them they must raise money while the sun is shining.
That's why we're glad to see that some of the parastatals are starting to have capital investment, and it would be nice if a lot of the private sector also started investing in the economy, because then they would need more money. And it will go a long way to not only giving a good return for investors, it will also help growth in the economy.
I mean, surely that's what they should be doing right now. In light of all the uncertainty, why don't they go to the market?
They're only human as we are. I mean, you're not going to spend money unless you see demand. And they don't see much demand at the moment, so they're not expanding. I mean, the mines are expanding, make no mistake, but they can raise money worldwide. They don't have to raise money in the South African market.
How dependent is this environment, the corporate bond market, on the economic climate?
Very much so. They need to make profits to pay us back. So if the economy slows down too much, then suddenly the risk element does creep in.
So the uncertainty is not good for you at the moment?
Not at all. The best environment is a confident sector, a confident economy that is growing fast, and therefore they need that extra money to invest, and we're happy to lend it to them.
In terms of the market environment at the moment, what are the thoughts being thrown around the table at Investec? Are you as uncertain as everyone else out there?
I think pretty much so. I think we're in an environment where, unfortunately, local fundamentals don't mean much. We're beholden to all the money that's been printed by central banks. I mean, you've seen the Fed, you've seen the ECB. They've printed money faster than they've ever done before. The quantum is enormous, their balance sheets, and that money is sloshing into all our markets. In our bond market, we've had just over 9 billion this year alone. Now, that is a fraction of what has been printed, but it's big enough to sway our market. So it ignores anything that happens on the local front, and we're beholden to the whims of, is Greece going to default today or not? And it's almost unfortunate that we are being topped and tailed a little bit by the foreign flows.
Mr. Bronwyn, investment managers, asset managers are never uncertain about their view. They're just uncertain as to whether their view is going to be right or not.
You've said that often on the show, Wayne. Inflation is key to your story. The negative real yields, obviously with inflation sitting above 6% at the moment. What are your thoughts on inflation going forward? Because that's, as I said, the biggest detractor to the cash story.
I think we on the slightly bullish side of inflation. If the world behaves itself,
big if.
There is always an if. But we see inflation topping up at about 6.5% by mid-year, and then sort of start coming down. And then really that's on the back. Food prices are starting to roll out the system. We've seen the fuel price roll out the system, so the base effects and all those things are coming down. And there isn't that much pricing power in the economy. A lot of the retailers in Minakat are protecting their market share, and therefore don't want to push up the rand effect price. So we think inflation should be okay, which plays back into the governor of the Reserve Bank's hands, that she'll keep rates on hold for a long time.
One caveat, though, is that the rand doesn't weaken excessively from these levels, because that, of course, could really hurt the inflation story.
No, very much so, because if you see the rand weaken, the first crisis, everyone panics, thinks inflation's going to go, and there is no follow-through. The second crisis, or the third, is really when it happens. So the first crisis is absorbed by corporates, And I think we've now seen that happen. The second one, they won't be as generous, and they'll be forced to put prices through. So that is why it is a big if and a big risk.
Wayne, the big
Yeah.
risk on the weakening of the rand?
Look, the rand can weaken at any stage. Currencies are notoriously volatile. But there's a lot, quite frankly, there's a lot of positive going for the country. I mean, our economy is not growing badly, but it's certainly going better than Europe and the US. Our government's finances, even though they have deteriorated, are still in relatively, quite frankly, in good shape compared to the US and in Europe. We
aren't an island, may I remind you?
No, totally. But I mean, understand the pressures. Okay, let's go back to the rand. Why did the rand, there are 3 episodes in living memory of the rand collapse. Okay, I won't go back to the 60s and the 80s, because you can even argue that's false. There's 3 episodes. One was when they abolished the financial rand and got rid of the tariffs and got rid of a bit of exchange control. So that was a one-off adjustment in the early 90s. I mean, the rand was actually totally and utterly artificial. So that was a necessary adjustment. Then we had the panic in the late 2000s where we panicked. We, collective South Africans, the rand was going, it was just, you had to take money overseas at any cost. Lucky Trevor Manuel said no more of these asset swaps, and he actually saved us from ourselves. So that was the second panic. And the third one was the credit crunch. But there's no fundamental economic reason
I'm not
as to
talking
why
about the rand going to 15 to the dollar. I'm just saying at 8.50, at 9, we're still looking at the impact on inflation. It will fuel inflation in the South African environment.
It'll be a spike in inflation. I think what we've got to realize is that, as Wayne said, the rand fundamentally is a good investment in the long term. So if it goes to 8.5, 9, it's a great buying opportunity for foreigners to come in. And I think you will see support come back in. And I think you'll see locals bring some money back at those levels.
So if you look at inflation now in South Africa, let's divide it into a couple of buckets. You get administered prices. There, the best example is Eskom. But it's not just Eskom. It's rates and taxes and refuse and anything to do with local government.
We know that 9 well, don't we?
And an airport company of South Africa and toll fees and everything. Okay, so that's probably running 15, 20%. That's not falling. Okay, so put that one aside. Then you got, let's call it consumables, for want of a better word, commodities. Fuel, food. Food looks as though it's going to fall. So that will be good news. Fuel, well, it can't go to 150, 160 again, because that in itself will probably cause an economic collapse. So maybe we're over the worst of the petrol price hikes. The other part of our basket, inflation's actually quite low in that part. People can't push the prices on. But unfortunately, that first little bucket, this is going to still be with us for a while.
Prices, as I said, we know it as consumers in South Africa.
And we're all feeling it, yes.
Malcolm, the pipeline, before we close out, in terms of corporate bonds in the pipeline, I know you can't disclose, but are you starting to see some robustness in that pipeline? Not yet. Economy.
Not enough. There's, at the moment, it's predominantly rollovers, so because the market's big enough, there's enough churn, and that's keeping us busy. But we've had a couple of interesting deals, and we've been involved with some borrowers. We've got a couple of pipelines. We would like a little bit more, and we'll keep going for it. And I think as growth picks up, I think there will be more opportunity.
Absolutely. Let's hope the economy turns. It will be a game changer on a number of aspects.